Imagine waking up tomorrow to news that China and Japan, the two largest foreign holders of U.S. debt, have suddenly dumped billions of dollars in Treasury bonds. You might think, it's just numbers on a screen, but this move could send shockwaves through the bond market, affect interest rates, shake the stock market, and even touch your savings, loans, and retirement accounts directly. In fact, this isn't just another headline, it's a potential warning signal of a major financial shift that most people aren't prepared for. The bond market underpins much of the global financial system, and when major players like China and Japan start pulling out, it's a sign that something big is brewing beneath the surface. Right now, the clock is ticking, and understanding what is happening could mean the difference between protecting your wealth or watching it erode in real time. On this channel, I break down complex financial moves like this so you can make informed decisions before the crisis hits. Today, we're diving deep into why these massive U.S. debt sell-offs are happening, what it means for you personally, and what steps you can take immediately to safeguard your money. By the end of this video, you'll have a clear picture of the looming risks and actionable strategies to stay ahead, so stay with me as we uncover the hidden warning signs that Wall Street doesn't want most people to see. The U.S. Treasury market is often called the backbone of the global financial system, and for good reason. Every year, the U.S. government borrows trillions of dollars to fund its spending, issuing Treasury bonds, notes, and bills that investors around the world purchase. These debt instruments are considered some of the safest investments on the planet because they are backed by the full faith and credit of the United States government. But here's the critical point. The U.S. does not hold all this debt itself. A huge portion of it is owned by foreign countries, with China and Japan consistently ranking as the top two holders. China alone has historically held over $1 trillion in U.S. Treasuries, while Japan hovers around $1 trillion as well. These countries buy U.S. debt not out of charity but as a strategic financial move. They earn interest on their investments, help maintain a stable U.S. dollar for global trade, and ensure their own economies benefit from a strong, reliable reserve currency. However, foreign ownership of U.S. debt is a double-edged sword. When countries like China or Japan decide to sell large amounts of U.S. bonds, it can have immediate ripple effects across global financial markets. The value of bonds can drop, interest rates can spike, and suddenly what was considered a safe investment becomes volatile. This is particularly important because Treasury bonds aren't just an abstract investment, they directly influence mortgage rates, car loans, student loans, corporate borrowing, and even the stock market. For decades, investors and governments have relied on the stability of these bonds to plan everything from retirement portfolios to national budgets. Historically, there have been periods of significant foreign selling, though usually gradual, that cause tension in the markets. For instance, during times of geopolitical tension or economic uncertainty, foreign holders have reduced their treasury exposure, prompting temporary spikes in yields and market anxiety. What makes the current situation alarming is the scale and speed. Reports now indicate that both China and Japan are offloading significant amounts of U.S. debt simultaneously, a move that hasn't been seen at this magnitude in years. Analysts suggest multiple reasons. China may be trying to protect its weakening currency and diversify its reserves, while Japan might be reacting to domestic economic pressures, including inflation and debt obligations. These sell-offs can create a chain reaction affecting everything from the U.S. dollar's strength to global interest rates, and ultimately impacting every investor and consumer. To fully grasp the stakes, it's essential to understand that U.S. Treasury bonds don't exist in isolation. They are deeply intertwined with almost every financial market worldwide. When major holders reduce their positions, it can spark volatility in equities, commodities, real estate, and even currencies. In essence, what starts as a foreign debt sell-off can quickly evolve into a widespread financial tremor, affecting not only Wall Street but Main Street as well. This is why understanding the current sell-off isn't just for economists or bankers, it is crucial for anyone with money in the system, whether that's a savings account, retirement fund, mortgage, or investment portfolio. The implications are real, immediate, and potentially severe, making it essential to pay attention, analyze the trends, and prepare strategically before the consequences ripple fully through the economy. One of the first indicators that a bond market collapse may be looming is a subtle but persistent shift in treasury yields and bond prices. When major holders like China and Japan begin selling large quantities of U.S. debt, the price of those bonds naturally falls because the market suddenly has more supply than demand. Since bond prices and yields move inversely, Falling bond prices mean rising yields, which translates into higher borrowing costs across the entire economy. This is why mortgage rates, auto loans, and corporate financing can spike seemingly overnight. For the everyday consumer, it might start with slightly higher credit card interest rates or a jump in mortgage payments, but if the trend accelerates, it can ripple across housing, business investments, and even stock market valuations. Another critical sign of a potential hidden collapse is unusual activity in the bond market that doesn't immediately make headlines. This can include large off-the-record trades, sudden increases in short selling of Treasury bonds, or skyrocketing volatility indexes that track bond price fluctuations. Unlike stock market crashes that often erupt visibly, bond market stress can build quietly, simmering beneath the surface until the impact becomes undeniable. Traders and institutional investors often notice subtle cracks first. A small spike in yields that seems out of proportion to economic fundamentals, or the Federal Reserve stepping in with emergency measures to stabilize prices. These are classic warning signs that the system is under stress, and historically, ignoring them has led to larger financial tremors. Liquidity issues are another major red flag. Treasury bonds are considered one of the most liquid assets in the world, meaning they can usually be bought or sold quickly without dramatically affecting the price. But during periods of massive foreign sell-offs, liquidity can dry up. Suddenly, large investors can't sell without triggering a significant drop in bond prices, creating a feedback loop where falling prices force more selling, which drives prices down even further. This chain reaction can escalate rapidly, turning what appears to be a normal market fluctuation into a full-blown crisis. Additionally, the correlation between bond prices and other financial indicators can offer early warnings. For example, if U.S. Treasury yields rise sharply while the stock market remains flat or starts to decline, it signals that bond market stress is beginning to affect broader economic confidence. Corporate borrowing costs increase, investment slows, and consumer spending may falter. This interconnectedness means that what starts as a debt sell-off by China or Japan can quickly influence nearly every sector of the economy, from real estate to equities to foreign exchange markets. Finally, it's important to watch for geopolitical or macroeconomic triggers that amplify these signals. Trade tensions, political disputes, or unexpected economic slowdowns can push foreign debt holders to accelerate sales, creating a perfect storm in the bond market. The combination of rising yields, liquidity constraints, and unusual trading patterns serves as a clear warning. The bond market is under pressure, and if the sell-off continues or escalates, it could lead to a collapse that affects not just Wall Street but everyday Americans. Recognizing these signs early is crucial because once panic sets in, the consequences can unfold rapidly, leaving little time to react. China and Japan selling U.S. debt is not a random event, it's a calculated response to both economic pressures and strategic considerations, and understanding their motivations is crucial to grasp the gravity of the situation. Starting with China, one of the primary reasons for selling treasuries is currency management. The Chinese yuan has faced persistent pressure against the dollar, and holding massive amounts of U.S. debt ties up capital that could otherwise be used to stabilize the yuan or invest in domestic priorities. By selling bonds, China can convert those dollars back into other assets, either to support its own currency, shore up foreign reserves, or invest in alternative assets that offer higher yields or strategic advantages. Additionally, China is navigating a slowing domestic economy, with challenges such as declining exports, rising corporate debt, and a real estate sector under strain. Liquidating portions of U.S. Treasuries provides liquidity to buffer these economic pressures while diversifying their foreign reserve portfolio to reduce dependency on U.S. debt. Japan's motivations are somewhat different, but equally significant. Japan has been dealing with its own economic challenges, including high domestic debt levels, an aging population, and decades of low growth and deflationary pressures. The Bank of Japan has long held a significant portion of Japanese government and foreign debt to maintain market stability, but in the face of rising interest rates and potential domestic fiscal constraints, selling U.S. Treasuries becomes a tool to manage their own balance sheets and mitigate risks from currency fluctuations. Japan may also be seeking higher-yielding investments abroad, as holding U.S. debt offers low returns in a rising interest rate environment. By reducing their U.S. debt exposure, Japan can reallocate capital more efficiently to protect its economy against global uncertainties. Geopolitical factors cannot be ignored either. Both China and Japan have been increasingly cautious in managing their exposure to U.S. financial instruments amid rising tensions and shifting global alliances. Large-scale debt sales can be seen as a strategic hedge against potential U.S. policy decisions, trade disputes, or sanctions that could affect the value of their holdings. While this is not necessarily aggressive, it does highlight that foreign debt holdings are not just about investment, they are deeply intertwined with national security and strategic positioning. From a market perspective, these sales are particularly impactful because China and Japan together hold roughly 20% of all U.S. Treasury securities held by foreign countries. When both decide to offload significant amounts simultaneously, the supply in the market spikes, and yields rise as buyers compete to acquire the remaining bonds. This creates upward pressure on interest rates and increases borrowing costs across the U.S. economy, affecting everything from mortgages to corporate loans to government spending. Ultimately, the sales by China and Japan are a mix of economic necessity, risk management, and strategic positioning. They are liquidating debt to support domestic economies, diversify their portfolios, hedge against geopolitical risks, and respond to changing global financial conditions. For the U.S. and the global markets, this is a warning sign. When the two largest holders of U.S. debt reduce their positions, it's not a minor blip. It can trigger widespread market volatility, rising interest rates, and a cascade of financial consequences that ripple far beyond Wall Street. When China and Japan start selling massive amounts of U.S. debt, it's easy to think, this is just about numbers on Wall Street. But the reality is far more personal and immediate for everyday Americans. The first and most direct impact is on interest rates. Treasury yields serve as the benchmark for a wide range of loans: mortgages, auto loans, student loans, credit cards, and even corporate borrowing. When bond prices fall due to heavy selling, yields rise, and borrowing becomes more expensive. This means your monthly mortgage payment could increase, refinancing may no longer be cost-effective, and businesses may slow down expansion or hiring because financing costs are higher. Even if you don't currently have a loan, rising interest rates indirectly affect the prices of goods and services, because companies pass on higher borrowing costs to consumers. The second area of impact is the stock market. U.S. Treasuries are considered one of the safest investments, and institutional investors often shift money between stocks and bonds depending on yields and risk appetite. When foreign holders like China and Japan dump treasuries, yields rise, making bonds more attractive relative to stocks. This can trigger a sell-off in equities as investors move their money into safer assets. For average Americans with 401ks, IRAs, or other investment accounts, this can mean a sudden decline in portfolio value, even if your long-term investment strategy hasn't changed. Retirees or anyone relying on investments for income can feel the effects almost immediately. Another important consequence is inflationary pressure. Rising yields on treasury bonds increase the cost of borrowing for businesses and the federal government alike. When companies face higher costs, they often pass them on to consumers through higher prices on goods and services. Simultaneously, government borrowing costs increase, potentially straining fiscal budgets and forcing cuts or reallocations in public spending, which can affect programs people rely on for healthcare, education, or social benefits. Combined, these factors can erode purchasing power and make everyday life more expensive, even if wages remain stagnant. Currency fluctuations are also a hidden but real effect. Large-scale selling of U.S. debt by China or Japan can put downward pressure on the dollar, affecting the cost of imported goods, travel, and international investments. A weaker dollar may seem beneficial for U.S. exporters, but for consumers, it often translates into higher prices for imported goods from electronics to everyday essentials. If the trend accelerates, foreign investors may demand higher yields to compensate for risk, further exacerbating borrowing costs and creating a self-reinforcing cycle. Finally, the psychological impact cannot be understated. Financial instability can cause a chain reaction of fear and caution among consumers and investors. People may reduce spending, delay major purchases, or withdraw money from investment accounts, which in turn slows economic growth. Even if the government or Federal Reserve steps in with emergency measures, the initial shock can trigger a period of uncertainty that affects everyday financial decisions for months, if not years. In short, what may appear to be an abstract international transaction, a foreign country selling U.S. debt, has very real consequences for anyone with money in the system. From higher interest rates to inflation, stock market volatility, and even psychological impacts on consumer behavior, the ripple effects touch almost every aspect of daily financial life. Understanding these connections is essential, because being prepared can make the difference between weathering the storm and being caught off guard. As China and Japan offload significant amounts of U.S. debt, The reaction of financial institutions and policymakers becomes a critical factor in determining how severe the fallout might be. The Federal Reserve, for instance, monitors Treasury yields and liquidity very closely. In times of stress, it can intervene by buying Treasuries directly to stabilize prices and ensure that borrowing costs don't spiral out of control. This type of intervention is designed to prevent panic from spreading through both domestic and international markets. Historically, the Fed has acted as the backstop of last resort, stepping in when foreign sell-offs or sudden market disruptions threaten the broader economy. However, its ability to fully counteract massive sell-offs has limits, especially when multiple global economic pressures converge simultaneously. Commercial banks and investment firms are also actively responding. Large institutions often adjust their portfolios in real time to hedge against rising yields or falling bond prices. Some may temporarily pull back from lending or increase collateral requirements to protect themselves, which can tighten credit availability for businesses and consumers. Hedge funds and institutional investors may also engage in short-term trades, betting on further market volatility, which can amplify price swings. While these moves are intended to protect their balance sheets, they can inadvertently increase market instability, creating a feedback loop that accelerates the impact of the initial debt sell-off. Another important action is the coordination or lack thereof between international central banks. In some scenarios, the Federal Reserve, Bank of Japan, and People's Bank of China might engage in subtle interventions to prevent market panic. These could include temporary currency swaps, coordinated bond buying programs, or public statements aimed at calming investors. The effectiveness of these measures depends on timing, scale, and market perception. Even a small delay or miscommunication can cause yields to spike sharply, further increasing borrowing costs and market stress. Looking ahead, analysts are closely watching several potential developments. If foreign selling continues at this pace, U.S. interest rates could rise sharply, slowing economic growth and pressuring consumer spending. The stock market may experience heightened volatility, with investors reallocating money into safer assets like gold, silver, or other sovereign bonds. There is also the risk of a broader credit crunch, where banks and financial institutions tighten lending standards to safeguard their capital, impacting small businesses and everyday borrowers. For everyday Americans, this means staying informed about institutional actions is key. Watching Fed announcements, tracking bond yields, and monitoring market liquidity indicators can give early warnings of further instability. Institutions may try to stabilize markets, but the combined effect of foreign sell-offs, rising interest rates, and economic uncertainty can still create real challenges for consumers, investors, and businesses. In essence, what institutions are doing now will influence whether this debt sell-off is a manageable ripple or the start of a much larger financial shockwave. The situation with China and Japan selling U.S. debt may seem distant, but there are concrete steps you can take right now to protect your finances and prepare for potential market turbulence. First and foremost, diversification is critical. Don't rely solely on traditional U.S. investments like stocks or bonds. Consider spreading your assets across multiple sectors, countries, and asset classes. Safe haven assets such as gold, silver, and other precious metals can act as a hedge against currency fluctuations and rising interest rates, preserving value when traditional markets become volatile. Second, review your debt and borrowing strategies. Rising Treasury yields will likely push interest rates higher across mortgages, personal loans, and credit cards. If possible, lock in fixed rates on loans or pay down high-interest debt to reduce vulnerability to sudden rate spikes. This not only saves money but also reduces financial stress if borrowing costs increase unexpectedly. Third, maintain liquidity. Having readily accessible cash or cash-equivalent assets allows you to navigate market turbulence without needing to sell investments at a loss. Emergencies, unexpected expenses, or sudden market opportunities are much easier to manage when you have liquid assets on hand. Fourth, stay informed and monitor key economic indicators. Watch Treasury yields, Fed announcements, foreign debt holdings, and market volatility indexes. Knowledge is your first line of defense. Understanding trends early allows you to make strategic decisions rather than reacting to crises after they unfold. Finally, adopt a long-term perspective while remaining flexible. Market turbulence can be temporary, but being prepared allows you to make smart, deliberate choices rather than panicking. Adjusting your portfolio gradually, diversifying strategically, and keeping a clear eye on global financial trends can help you weather shocks and even take advantage of opportunities when others are forced to react emotionally. These steps aren't about panic, they're about control. By diversifying, reducing exposure to rising borrowing costs, maintaining liquidity, staying informed, and keeping a flexible long-term strategy, you position yourself to protect your wealth and navigate the uncertainties of a shifting bond market. Now that you understand the potential risks of China and Japan dumping U.S. debt, it's clear that the bond market isn't just abstract numbers, it affects your loans, investments, and everyday financial life. Staying informed and taking proactive steps can make a huge difference in protecting your wealth and preparing for what is coming. If you found this breakdown valuable, make sure to hit the like button and subscribe to the channel so you never miss critical updates that could impact your money. Turn on notifications, because we'll be diving even deeper into how to safeguard your assets and which markets are safest if these trends continue. Drop a comment below with your thoughts. Are you adjusting your investments in response to these warnings, or are you waiting to see what happens next? Sharing your strategies helps the whole community learn and stay prepared. Remember, knowledge and timely action are your best defense in volatile times, so stay vigilant, stay informed, and stay ahead.